Okay, we're rolling. Well, welcome back to Jackie Feagin Associates, where we talk about real talk about real estate. And I'm here today with our team member, Whitney Rasco Turner.
Yeah.
And Caitlin Ferguson. And I am Jackie Feagin, and we've got our special guest today, Katie Brunson with Heavy Metal Mortgage Team.
Thank you for having me.
Welcome, welcome.
Welcome.
Girl.
Yeah. So we're here today, and why we invited Katie is because we're going to talk about how you buy and sell a home when you're already living in a home. And we've been getting that question a lot lately. So we really wanted to focus on how people can qualify to do that when they have to get a mortgage. And so Katie is our mortgage expert, and she is going to let us know a little bit about the types of financing that's available. And then we'll just kind of roll with it and see what kind of questions we have.
Awesome. Okay. So one of the biggest concerns people have when they are going to buy and sell at the same time is, how can I qualify? And sometimes they also worry about, can I go contingent or non-contingent? So the first thing we do is we dive in and customize everything based on their financial profile. We look at, can their debt ratio carry both mortgages? And a lot of times it actually can, and they may not realize it. If they're carrying an FHA loan on their current home, they typically would have a great interest rate right now. The mortgage is lower. Most people have grown in their careers and they have more income. They can look at maybe using some of their savings as a down payment and then reimbursing themselves after they've closed. And some people don't think about that, is, tap into something that I've got now and I can always pay myself back after I've sold my current home.
Okay, so tell us about an FHA buyer. What are they looking to put down when they're looking to buy a second property? What goes into that?
Yep. So if they are getting an FHA loan on their second home, they're actually still eligible to put down 3.5%. A lot of people don't know that. And some people think FHA stands for first time home buyer. It doesn't. It stands for Federal Housing Authority. So some people say, actually I got a client yesterday, when can I use my FHA again? And I'm like, tomorrow? So you can absolutely do that. And FHA actually allows for great flexibility with the debt to income ratio. You can push it up higher than you can on other loan types.
So 3.5%
Yeah.
down.
3.5%.
Who doesn't qualify for FHA in that scenario?
So if you have an existing FHA loan and you want to keep your current home, you cannot have two FHA loans at a time typically. There are some exceptions, but the box is relatively small. Additionally, if there is a situation where you want to keep the home but your debt ratio can't handle it, there's some very particular qualifications when it comes to rental income. In general, though, we just need about a 620 credit score. So some people don't realize that. They think that they've got to have perfect credit because they're buying a second home, and that's not the case. And the only other thing I see, sometimes people haven't thought about closing costs and down payment together. So we have to create that strategy before they go out shopping.
Okay.
What's another scenario with, say, a conventional loan? If someone owns a property with a conventional loan, how would they go about selling, or what would their options be?
That's an awesome question. One of the biggest misconceptions I get is, well, I'm not a first-time buyer. I have to put down 20%. That is not accurate. 5% is the minimum for conventional, and that gives you so much flexibility. If you want to sell and then buy at the same time, if you've got that 5%, it's the same thing. And then if you want to put down more, you can, or you can use that money to fix up the property, cover your closing costs. So that gives you an amazing opportunity to be very flexible, and it solves the misconception that you have to have absolutely a giant chunk of money, because you don't.
So when did that change for conventional loan? Because I remember I had one of my very first buyers who was buying a luxury home. They had to put down 20%, and that was a lot of cash.
Mm-hmm.
We're talking over 6 figures cash. So did that change recently with the conventional?
It's been like that for a while. The agencies, Fannie Mae and Freddie Mac, those are the people who create the guidelines for conventional, recognized probably around 20 years ago that these old-fashioned standards just did not apply to regular people.
Right.
Even on the jumbo side, we have some products that allow you to put down as little as 10%, even if you're borrowing over $1 million. And so the flexibility has really increased. And I wish people knew that these things were possible because they're so used to those old-fashioned guidelines that don't even exist anymore.
So Katie just told you guys my age because she said over 20 years ago.
Jackie was 22. Jackie was only 22.
That was a good thing.
20 years ago, that's when that changed.
Jackie was 22.
So now, with the conventional that they can do as little as 5% and get a second home, that really does open up a lot for a lot of people. Questions, you guys?
Yeah, VA.
Well, yeah, you touched on the fact that FHA, that part changed and they no longer have to put down 20%. You also mentioned luxury, and that brings to another point that there are people out there purchasing homes using VA loans, and they can also purchase in that range as well. So that was something I know that we
Yes. In
touched on before.
2021, VA had a massive change that a lot of people don't know about, and I wish that they did. So there are loan limits based on area. VA came out and said, you know what, if you can qualify for the mortgage, we'll guarantee it. So you're no longer boxed in by the loan limit from the county if you don't have any of your entitlement used. So if you're a veteran and you want to move up into a luxury home that's $1.5 million, VA says, you know what, you've earned it. If you can qualify for it, we will guarantee it. The other thing people don't realize when they want to buy another home is that you can keep your VA loan on your current home and then use what we call split entitlement. And so if you're buying with a spouse that's also a veteran, we can use both entitlements. Or we can use what we call bonus entitlement. So then we have a worksheet, because you know VA loves their worksheets.
They do.
And then we can calculate how much can you borrow without any money down. And if you want to go over that limit, there are still reduced down payment options.
So what if you go over the VA limit, and that is per person, per veteran, correct? What is what's the limits that they're looking at?
So in our area, it's a funky round number. It's like 700 and some change. In Northern Virginia, it's like 800 and some change. But the formula is, let's say you have a VA loan right now for $500,000. You want to go up to $1 million. VA will say, okay, you've got to put down $200,000 to get there. Well, you only need technically 25% of that as your down payment. And all you're doing is substituting the insurance that VA can't offer you because of the entitlement that you have left. So you don't even have to put down the whole difference. People don't realize that.
Yeah, people don't realize that. I had a situation last year where a VA buyer wanted to buy a home that was in the over $2 million price range. And we really had a hard time with the other agent. The agent did not even want to present the offer to her seller because it was a VA. And I found myself educating another agent about it, and the lender had to educate that agent as well. So I just want to take that misconception away from the public, saying that just because it's a VA loan doesn't mean that it's someone that is not buying in the luxury space. They can go up to $3 million. Is that correct?
Yeah, and in some cases, depending on the situation, they can go over. It just depends. Like we have certain investors that will allow that. The other thing is I do get pushbacks. I do a lot of work in the DC area, so those are higher income prices. And I got pushback last week from an agent that said, you know, we were in like the 900 price range. Well, why aren't they putting down a down payment? I said, because they've earned the privilege not to.
Say that again.
Correct.
They have
Say that
earned their down payment was left on the battlefield, sir.
Yeah, and you know, so that's a space that I love to work in, is with veterans and earning the privilege, and that is what that is. They've earned the privilege to do that type of loan. So we shouldn't get those types of questions, but we still do.
We do.
Mm-hmm. So what is the qualifications for a VA loan?
Great question. So you have to have a certificate of eligibility, which we will help people get. And that says that you are entitled to have a VA loan. On the credit side of things, some investors will go down as low as 585. However, we find it in the client's best interest to help them boost their score, and sometimes we can do that relatively cheaply. You have to have income that's verifiable, and something really important. A lot of veterans or active duty say, okay, well, I'm going to get out in about 8 months, so I want to use my BAH now to qualify. VA knows that people do that, and there's a little section of the guideline that says if your ETS date is 12 months or less, you have to have a letter saying that you intend to re-enlist, and you have to have a statement of service that says you are qualified and eligible to re-enlist. So you can't really work the system. We have to make sure your income is going to continue.
And does that work for someone who's thinking about retirement as well?
Yes, great question. And actually, this goes for all loan types. If you're in your job and you are about to retire, we have to qualify you on your retirement income. So we have to be able to document what you're getting so that we can utilize that instead of your current salary.
And whatever job that they may be going to, you can factor that in as well if they have something like an offer letter.
Yes.
Or something that can be factored in.
Yes, and actually that's a great point because there's two kinds of offer letters, right? There's contingent and non-contingent. So if it's contingent on completing a degree, for example, that would not work. But if it's contingent on things like a background check, that's completely fine. If it's salary, we can actually typically utilize it before the job starts, as long as they will get a paycheck before the first mortgage payment. If they are hourly, we have to go a little bit more in depth, and in some cases they have to be on the job for 30 days so we can verify that they're getting the full-time hours.
So if I'm hearing you correctly, if you're thinking about retiring or getting out and you want to buy a house, you should really do it before your year is
Yes.
up, because then that way you don't have to get all that extra additional paperwork.
Absolutely.
So, you know, that could be good for someone who's saying, I'm at my last duty station, this is where I'm going to be retiring. So think about buying that house now rather than waiting until you put in that retirement or, you know, your option to re-enlist back out there. So get that property now.
Yes.
I also have another question about the VA loan, the debt to income ratio. Are there any differences there with the VA borrower?
Awesome question. So VA does not have a debt to income ratio limit. Most people don't know that. They actually work off of a cash flow system called residual income. And that is where we have to plug in a bunch of data that's not factored in other loan types to make sure that they have enough money left over after their paychecks each month to cover the bills. And so maybe on the front end, we see a debt ratio of 58%. But if they make $150,000 a year and they really don't have any other bills, and we can get them through the automated underwriting and they meet that residual income, and they've got good reserves, then VA says that's an acceptable risk that we're willing to take on.
I like that.
Reserves, can you go over?
Yes, good. Sorry about that.
I'm like, we're using all these technical lingos, and I know you guys don't know what that is. But
Yes,
let's
good question. Reserves is the lender word for savings, and reserves are categorized by several different classifications. One we call liquid. Liquid is checking, savings, money market, things that if you have a problem, you can get to very quickly. We like to see that. Most people don't know that your retirement can count as reserves, because if you have a TSP and you have an emergency, you can borrow against that. So you should upload your retirement statement when you apply. It makes your file much more attractive because we can show that you have a safety buffer.
We use another term, TSP. What is that?
That is a thrift savings plan. So if you work for the government or you are in the military, that is the government's version of a 401k.
Great.
Yeah. Any other VA questions?
What about conventional
Yeah.
Great question.
qualifications
Yes.
just to get started?
Conventional is what we like to refer to as your traditional old-fashioned loan. So they are looking for typically cleaner credit. They are going to want to see you've not really had any late payments, you're not close to maxing out your credit cards. All of these underwriting algorithms, most people don't realize our industry has been using AI for years. So we have automated underwriting, and we put your file through, and the system says, yes, we like this, or not so much. And so it's our job to put in all of the data. And so with conventional, we really like to see a good debt to income ratio. 50% is the cap on that. Most people don't know you have two debt ratios. You have what we call our front ratio. That is your housing payment compared to your gross income. And then you have your back ratio, which is all of your debt, including housing, compared to your gross income. And I say gross because a lot of people, when they fill out the application, they put in net income, but we actually are allowed to go off of your gross. And if you get other things like child support or alimony, in a lot of cases, if it's non-taxable, conventional financing allows me to add 25%. So if you get $100 a month in child support, I can count $125 a month, and that just boosts what you qualify for.
Nice. One thing we didn't talk about with VA, and I guess we can cover it for all three of them, interest rate differences.
Yes, good question. So interest rates have so many factors that go into them. VA in general is going to give you the very best interest rate available on the market. FHA rates are subsidized by the government, so they are lower than conventional. However, we have to look at the other factors with FHA, like the mortgage insurance components. Conventional financing, those rates are extraordinarily sensitive to your credit score, your loan to value ratio, how much are you putting down, as well as the market. And then there's another component, of course, mortgage insurance. If you are using a VA loan, you do not have monthly mortgage insurance. If you're using conventional and you're putting down less than 20%, you do have mortgage insurance, and same thing with FHA, you do have mortgage insurance there.
And at 20, is it still at 20% once it's paid? Or is the, are they allowed to apply to have that PMI, private mortgage insurance, removed?
Great question. So FHA and conventional differ on this topic. With FHA, if you're putting down the 3.5%, the mortgage insurance is permanent for the life of the loan. It does not go away. That's why I say, at least on my team, we work off of what I call economic efficiency. It's not always about the rate. The rate can be smaller, but the payment can be higher, and it's because of things like this. With conventional, yes. So you have the ability at 20% equity based on the sales price, not the market, to call and say, I would like this to go away. At 78%, so you've built up 22% in equity, the government says it has to come off automatically. But in these environments, people are gaining equity very quickly. And a lot of times you can call, and instead of refinancing, you can say, I'd like to pay for an appraisal. And they'll let you do that and then reconsider the equity position and let you get rid of the mortgage insurance sooner.
Wow.
So when they allow you to pay for the appraisal, do you choose the appraiser, or that's something that's automatically generated from the lender?
Great question. It depends on the servicer. Many times, if you have a local appraisal company and they're certified and the servicer has worked with them in the past, they will allow you to place the order. They still review it. They may still reach out to the appraiser to ask questions. Most of the time, they'll actually do what we call a desktop review, which is where they pull it in automatically. It's like it's artificial intelligence, and it analyzes the market, and they charge you $300 to click a button. But if it saves you mortgage insurance, totally worth it.
Absolutely.
So we're using AI in lots of spaces these days.
Yes, and my industry has been like one of the first, and most people don't realize that we pioneered a lot of the techniques that look at risk management through AI.
So some of the things AI can't do is work with people directly.
100%.
And I know Whitney has a story that her FHA buyer did that is a story that people need to know about some FHA products in our areas.
So not AI related, but I did have a client who came to me with a housing voucher, and she needed a new house. So we looked at rentals for her using that voucher, and we weren't having much luck because for whatever reason she was getting denied. And she was qualified. She had credit over 620. She had income. She worked. She also had child support. And then something I was just clicked, and I was just like, have you tried applying for a mortgage loan? And she said, I have, and it didn't work out. And I called somebody, Katie, and I said, I hope you can help us. Here's the situation on my end. It sounds like she should be able to qualify, but being a little bit of unaware of how housing vouchers work, I'm just like, she does have a housing voucher. Can we use that? Like, what can we do? And long story short, she ended up qualifying with all of her income combined. The housing voucher, we didn't need it anymore. And she purchased a house that was 2 summers ago. 2 summers ago. So from housing voucher to home ownership.
Yeah, so we actually used a state program called Virginia Housing. So a lot of people are familiar with that. They've gotten much better about advertising, but they have grants available. They have no money down. And a lot of people either maybe have a stigma about these programs, or they don't know that they exist, or they think that they don't qualify. And VHDA has really increased their qualifications. And now, I mean, they have some programs where you can make up to $152,000 a year and put down no money.
Yes, that's a great program that we have here in the state, and having those grants available. So reach out to your lender, hopefully Katie, so she can help you get those grants that you can, end up being a home buyer. So I had some interesting things happen when people get a mortgage, or they get approved for a mortgage, I should say. They think they're golden. That ticket is, it's my time to go buy whatever, and now, I got a contract, it's ratified, it's good, I can now do whatever. Tell us some of the things that they cannot do once they've applied for a mortgage.
Oh, I had this last week. Okay, so I had a young man who didn't read our email. And anytime you get under contract, and anytime before, the agent and we always say, please don't buy anything on credit. This is not the time to finance furniture for your new home. It's not the time to do anything. Please don't buy a boat. Don't go crazy. This young man didn't realize that we do a credit refresh prior to closing, even though we told him, and it's in the email that he didn't read. And he went out and purchased himself a brand new car. He said, the guy at the dealership told me that you weren't going to see that because my first payment wasn't due yet. And I said, sir, I used to sell cars. They'll tell you anything.
They'll tell you anything.
They will. And so when I pulled his credit and we did the refresh, his debt ratio went from 35 to 55. That's a problem. And so we had to completely restructure his loan. He had to go pay off a bunch of stuff to qualify, and didn't realize that he almost cost himself a house. And in many cases, people have had to be denied at the end. Also, please don't quit your job. We've had that happen. We always have to do a verification of employment 3 to 5 days before closing, and most of the time it's fine. The manager says, yes, they still work here. Well, we called one day and the person said, oh yeah, they got fired last week. And so we called the gentleman and said, sir, what happened? He said, oh, don't worry, it's fine. I'm working for a temp agency now. You can't do that. That's bad.
No, I had a client who, he got very fed up with his job. We were 5 days from closing, and even though we were told don't do anything, he was like, 5 days, I'm golden, I'm good. He quit his job. Well, the lender called that very afternoon to verify, and his wife, I think they have a divorce, but they're divorced now. I'm pretty sure, because he quit his job. Even though he had another job lined up, that job wasn't going to kick in for 60 days, and they could not hold that mortgage, nor was the seller willing to hold the house until that. So he ended up losing his, down payment or earnest money deposit, because again, all of those things are told, and it was seen as fraud on the buyer's part. So he did end up losing his earnest money deposit. I don't ever want to see anyone lose their earnest money deposit. It's just something that if you do something that you've signed the paper saying, I'm aware of this, do something like that at the last minute, you could, not only will you lose the house you wanted to buy, but your earnest money deposit goes away, and it leaves everybody in a bad situation.
And you could be in serious trouble after that.
Yeah.
Seriously. So don't do it. Listen to your agent. You are in a legally binding contract, and although we are not lawyers, these are contracts.
These are
So,
contracts. That's
You know?
that's what they do. So, other than losing their job, what are some of the other things to get the clear to close that a lender needs?
So when
The best news ever,
yes,
by the way.
oh, that's my favorite.
Yes, when you're waiting, holding your breath for that clear to close on some
Yeah,
of
if
these.
somebody ever asks somebody in our industry what your favorite words are, we're all saying clear to close. So when we sat down, you mentioned cavers.
Oh, I forgot about that. So I won't tell you my age, but well over a few decades now, I've been in this business and never heard this term cavers before. And we were a week away from closing presently on a house that we needed to sell because both people in the house are active duty and their ship is going bye-bye and they will be gone. And so we needed to sell this house. Well, 5 days before closing, I got just a text message saying, "Cavers, sorry, loan denial letter." I did not know what this term
That's
meant.
crazy.
Literally panicked.
Text.
Yeah, you
texted me this.
Text me like that.
Yeah, I was like, wait a minute. First of all, why are you texting me
Yes.
that we're about to get
Sorry.
a release?
FaceTime
Yeah,
me.
Sorry.
Yeah, sorry. I was like, you need to call, get on the phone. So I had to call several lenders to find out what that term means. So Katie, tell us what that
Yes.
term means.
So we want to believe you when you apply and you check the box that says, no, I am not delinquent on federal debt. We want to believe you. However, we can't always believe people. So what people don't know on the back end to get a clear to close is that we run two reports, TQL, which is a type of fraud report, and we run CAVERS. CAVERS is a system that the government uses to report people who are delinquent on federal debt, taxes, student loans, Social Security overpayments, you name it. If you owe the government money, a lot of times it shows up in this system.
Is there an amount? Because a lot of people have student loans and they don't end up in that CAVER system. Is there an amount?
It's only if you're in default.
Okay. in
So
default,
if you
okay.
are in good standing with your student loans, you have nothing to worry about. And
Okay.
some student loans don't always show up on CAVERS, but if they're on your credit, we still have to do a supplement, like if it shows that you're behind. So people don't know that we'll find that out even if you lie to us. The other system is called TQL. That's a fraud report system. Most people don't know. I can see every property that you have owned for a very long time. And even if you have sold it 5 years ago, if you were behind, I get what's called an NOD, notice of default. I can see if you went into pre-foreclosure. So if you had your credit report cleaned up by some company that had it deleted, I'm still going to know about it. So we tell everybody, be transparent because we can see. Or if you forget to tell me that you own other property because you know it'll mess up your debt ratio because you're on the title and you have to pay condo fees, we're going to find out about it. So honesty is really important in these situations. Also, don't lie to me about child support.
Yes, they're going to find it. It is so important to be transparent with your loan officer because sometimes they can figure this stuff out and how to structure the loan so you can get qualified. But if they find out about it at the last minute, like this CAVERS, which the buyer thought since the government had written it off and it wasn't on his credit report, his credit score was well over the 700s, that he was fine. But he was not fine when they pulled that report, and it was heartbreaking for everyone involved, especially for the buyer who is now technically homeless because they were going to close and they, turned in their lease, and so a lot of things came to play with that.
Yeah.
Can we touch on one other thing? Credit.
Oh, yes.
So we talked in our introduction video that my favorite type of transaction is with somebody who's a first-time home buyer, and I get so many that do have credit, need credit help. I won't say credit issues, but they do need credit help, and you have been so helpful in helping so many of my clients go from not qualified and being first-time home buyer to being clear to close. So can you go over your strategy for helping people with credit?
Yeah, of course. So a lot of lenders have the philosophy, oh, if you don't qualify now, I'm just going to tell you no and too bad. I don't operate that way. I think that's terrible. So I don't ever tell anybody no. Sometimes I have to say not yet. And so we don't believe in leaving anybody on an island. And so if we pull credit and we're not where we need to be, we'll give you a free credit action plan. So you have the exact checklist you need to get to where you want to be. We use a special modeling software, again, AI, and we can tell you the cheapest way to get you there. Also, something people don't know. Oh, I have a lot of medical collections. Guess what? Unless those are judgments, we don't count them against you. I had a lady who, and this is for every loan type, just so you know, the government has recognized that medical debt doesn't even, they think, belong on credit. So they're working on that. So medical debt no longer appears on credit.
Awesome.
But I had a lady whose husband had a heart attack and passed away. She had $250,000 in medical collections, and she was still able to buy. So as long as your credit score is over the minimum and we can get you approved, we don't care if you have medical collections.
Nice. Well, yeah, that's awesome.
So I like that term, not yet.
Not right now.
Not right now. And there are so few lenders that's unwilling to work with the buyers who are not ready right now. And that's why we don't want you guys calling Katie just because she can do all the not yet, because she has to feed her children daily. So we want her to get all the loans that are also ready right now. But working with someone that can work with the not yet and get you qualified is just having that person by your side is always great to have.
And you can actually do a lot of it yourself for free. Some people feel like they have to pay a credit repair specialist, and that's not true. There's nothing they do that you can't do for free. And if you need to know what your scores are, you can download an app called MyFICO, because there's a million different kinds of credit scores, and it'll tell you your mortgage scores. And so, you know, if you can see that there's speed bumps there, they give you your credit reports, and you can go through it yourself and pretty quickly figure out what you need to take care of.
Yep.
So Katie just used another term that people are unaware of, that I feel that people are unaware of. Mortgage credit score.
Yes.
It's not the ones that you get from
Credit
Rocket
Karma.
Mortgage,
Yeah.
Credit Karma. That is
Consumer credit.
Yes, that's consumer credit, and your mortgage credit score is two different things. So you got to get your mortgage score, and that's when she's talking about that minimum score. That's what the lenders are looking for when you're looking to buy a house.
And it's good to talk to a lender that can explain how to clean up your credit to get the mortgage, so you're not doing unnecessary things. Because if you can get the mortgage, then you're fine. So if you can work with a lender and with an agent, and you know, have a team of people who can develop a plan for like that, then that's really helpful. One big complaint that we get all the time, and I know that y'all have heard this: why is the lender asking me for so many documents?
Yes.
Why do they need everything from start to finish? And you kind of touched on some of that with, you want to believe them, but
that's true.
can you
Documentation.
please touch on that for the people?
Of course. So there's a few reasons. So some lenders kind of work backwards. They pull your credit, they believe what you say, and they hand you a letter and they hope for the best. We are the opposite. If my name is going on that letter, it's my reputation in the community. And so the last thing I want is a listing agent to call me to validate a letter that I can't back up. So yes, I may ask you for W-2s, pay stubs, bank statements, but I have to be able to also calculate your income. There's so many people out there that put their income in wrong, especially if they're paid hourly. So you may actually be shortchanging yourself on the application if you put in your net and not your gross. But also, I need to go through your bank statements. And listen, if you look at my statements, it looks like I live at Starbucks. And there is no judgment. I just want to emphasize that, because people do. It feels like I equate it to going to the doctor and getting naked and sitting on the crunchy paper in the gown and feeling really nervous and embarrassed. But you know, we're not judgmental. It is. And I feel, you know, we have seen everything. And we often see things that, you know, when you have spouses that have two separate bank accounts. And so, of course, there's a layer of privacy there that we don't violate. We just need to know so that we can give you the very best information. I firmly believe you cannot go into a transaction like this without having the best quality information available to you. And that means you've got to give me your documents.
Hey, when I apply for a mortgage, it looks like I work for Amazon. It's like Amazon. I'm sure Whitney probably has California Pizza Kitchen. So, Kaylin,
Mine says toastique.
So yeah, we don't want everybody to know that we go to those places
Right.
5-6 times a day, but the lender will see it all. They will see it all. And again, no judgment. They're just trying to get you qualified so you could buy your dream home.
Yes.
And one very important point, please do not send me Sharpied out bank statements because I can't use them. And so also, funny story, most people don't realize we can still read through the Sharpie when you scan it in.
Because the light.
The light.
Yeah, it's lighter, and when you go to scan it, the light goes through it. But we can't use anything redacted because that is just an additional red flag. So, if you really enjoy going to the ABC store every day, we don't care.
Right.
We
Just make sure you can afford this house.
Just
Right.
make sure you can afford the house.
That's right.
So Katie mentioned the listing agent calling her. So that is something, before I even present an offer to my sellers, I'm calling the loan officer, say, hey, I got so-and-so and this pre-approval letter from you. I just need to verify. And if the lender's like, who?
Red flag.
That's a red flag. That means that lender has 100 people on their team and they're just sending letters out. If the lender knows nothing about you personally, it's like, oh, do we really want that one? Because we want someone that has actually spoken with the client and knows what they need to do. At least that's what I look for. How other people do their business is different. But if I get a letter from a lender, I'm calling and I'm saying, hey, I got a approval letter from you for so-and-so. And if there's a long pause, it's a red flag for me right there and then. It's around like,
Let me check. Hold on a minute.
Yes.
Yeah.
Can I call you right back?
Yeah,
No, never
that's
mind.
a red flag for me. So a lender who is, knows their people and knows the loan, and then they say, oh yeah, this person's golden. We did, a tri-merge credit score. They turned in all their documents. That's when I go sit down with my seller presenting offers. I'm going to say, hey, I talked to all the lenders, but here's what this one had to say. And that could be, even if you're not the highest offer, if you've got a strong lender that's going to back it up, that's probably the offer my clients are going to take.
Yeah, and I try to reach out proactively. So as soon as Whitney texts me and says offer submitted, I'll have like a text out to the listing agent within about 30 seconds. And, my goal is to say, hi, I've already run the numbers on this particular property. Everything I have on the letter matches the contract submitted. They are good to go. And my letters actually have the conditions. So then by the time you're done with me, the only thing I need from you to get you to the table is an appraisal, clean title work from the seller side, and home insurance.
So this means that you are doing pre-approvals.
Yes.
Not pre-qualification.
Yes, the main difference is the underwriting. So I personally underwrite everybody and upfront through both systems that we have. We have two. And if it's a sticky file, I'll send it for a second level review with our underwriting department. A pre-qualification is a loan officer's opinion. And to me, that's just not strong enough. I mean, I would love to give people my opinion, but
I think you can buy this house.
Yeah.
And I think that's not something that you want, but this can be done across VA, conventional, FHA.
all
loan.
of them.
You want to be.
Yes. And a client should ask, am I pre-approved? Because a pre-qualification sounds great to a first-time buyer, but if they don't know the difference, they don't know that they could be in jeopardy of not closing.
Correct.
Yeah, and I'll tell all my clients, I said, I can do everything for you. I cannot loan you the money to buy this house. So let's make sure you are pre-approved. And, I can't speak enough about using a lender that's going to do a pre-approval for you, not a pre-qual.
Your thoughts on, and we've actually had this situation before, people who come to you, you cannot pre-approve them, they go elsewhere, they get pre-approved. What's up?
Yep. So usually it's one of two situations. One, they forgot to tell me something important that could change their loan status, and by the time they got to the other loan officer, they remembered, oh yeah, I'd get $400 a month in alimony, because there's that. Or they get a pre-qualification. There are several larger institutions that just take what comes in on the internet, process it through, and hand out a letter. And so 9 times out of 10, they get under contract, they get denied, and they come back to me, they're like, I am so sorry. So that's
Which is why we
happens.
always suggest our clients to stay local, because you can get anything from some of the larger companies.
And verify pre-approval.
Yes.
Verify pre-approval. Well, thank you so much, Katie, for being with us today. And again, this is Real Talk with Jackie Feagin Associates. Don't forget to subscribe, like us, or share our content if you'd like to see more of this. And thank you so much for being with us today.
Thank you
See
so
you
much.
guys.